Stop what you're doing. There is a war brewing in Washington, D.C., and it's a fight for your money. Right now, your ability to earn up to 4% or more on your digital assets, rewards that put bank savings accounts to shame, is under direct threat. The US Senate is debating a legislative proposal, driven by powerful banking lobbies, that would effectively ban the crypto rewards programs offered by companies like Coinbase and Kraken. But this isn't just about a few percentage points. According to Coinbase CEO Brian Armstrong, this proposed ban is a smokescreen. His direct accusation: it's nothing less than a bank bailout, a deliberate attempt to tilt the financial playing field back in favor of legacy institutions that refuse to compete. Is Washington about to sacrifice financial innovation and consumer choice just to protect the profits of Wall Street giants? That is the billion-dollar question we're answering today. Stick around, because the details of this legislative battle, and what it means for every single person holding crypto, are shocking. Welcome back to the channel. I'm Your Name, and on this channel, we cut through the noise to bring you the cold, hard facts about the intersection of finance and crypto. Today, we're breaking down the three critical layers of this story: the legislative threat. What exactly is the proposed Senate ban and the underlying bill, the Genius Act, that has the banking industry so fired up? Armstrong's nuclear counter: why is the Coinbase CEO calling this a bank bailout, and what data supports his claim that banks are terrified of losing trillions in deposits? Your action plan: what can you, the investor, do right now to protect your ability to earn passive income in the crypto space? Let's start with the basics. What are crypto rewards, and why is the banking industry fighting them so hard? The specific focus of this legislative push isn't necessarily staking on volatile assets like Ethereum, it's primarily on the stablecoin rewards. Companies like Coinbase, which co-founded the stablecoin USDC with Circle, offer a reward or yield on customers' stablecoin holdings. Coinbase, for example, has been offering yields around the 4.1% mark. Kraken has been even higher at 5.5%. Compare that to the average US bank savings account, which often offers paltry rates, sometimes less than 0.5%. The Senate has already passed a framework for stablecoin regulation known as the Genius Act. This act already prohibits stablecoin issuers from paying interest on the tokens. But here's the loophole the banks are desperate to close: crypto exchanges like Coinbase are offering rewards for holding stablecoins issued by other entities. They are exploiting a legal distinction between interest, which the issuer can't pay, and rewards, which the exchange can pay. The powerful banking trade groups like the American Bankers Association and the Bank Policy Institute, are now intensely lobbying the Senate to include a clause in the upcoming crypto market structure bill that would effectively reclassify these rewards to be treated exactly like interest payments. This would shut them down completely. Their public argument, as voiced by executives at the Bank Policy Institute, is that these high rewards pose a threat to the country's broader economic stability. They claim that consumers pulling their deposits out of banks and moving them into stable coin rewards programs could, neutering, to some degree, the ability of the banks to continue to lend into the real economy. In short, they say it will break their lending models and hurt the economy. But, as we'll see, Brian Armstrong has a completely different take on why the banks are really shaking in their boots. Brian Armstrong is not one to mince words, and he has come out swinging against the banking industry's claims. He dismisses their public statements as nothing more than a boogeyman narrative. Armstrong's core argument is simple: the banks aren't worried about the stability of the US economy, they are worried about the stability of their own massive, entrenched profits. He suggests the banking lobby is pushing this ban for two main, deeply self-serving reasons. The first reason is fear. The banks are terrified of a $6.6 trillion capital outflow from their institutions. Yes, you heard that right, $6.6 trillion. This estimate came from an unlikely source, an April report from the Treasury Borrowing Advisory Committee. The report modeled what could happen if stablecoin reward systems continued to grow, estimating that up to $6.6 trillion in customer deposits, a massive chunk of the US financial system, could shift from traditional bank accounts into stablecoin investments seeking higher yield. For a bank, deposits are the fuel for their lending business. Losing trillions means their entire business model is destabilized, not by a market crash, but by better competition. They can't offer 4% or 5% yields because their antiquated business models and expensive overhead simply won't allow it. Instead of innovating, they are running to their friends in the Senate to crush the competition. As Armstrong said, and I quote, "I'm not sure why the banks would want to bring that up again at this point. But they should have to compete on a level playing field in crypto." Armstrong's second, and perhaps more explosive, accusation is that this is about protecting the bank's lucrative payments business, which he estimates is worth around $180 billion annually. Think about what banks charge for cross-border transfers, wire fees, and the fees they skim off every payment transaction. The existing system is slow, expensive, and opaque. Crypto, using modern, efficient rails, makes payments virtually instant and dramatically cheaper. Armstrong argues that the real force driving this lobbying is not the small community banks, as is often suggested, but the mega banks who are trying to protect their core payment monopolies. He called the argument against crypto rewards a fake narrative used to disguise a corporate power play. The real reason that they're bringing this up as an issue, he stated, is that they're trying to protect the $180 billion that they made on their payment business. This is why he calls it a bank bailout. It's not a cash injection from the government, but a regulatory bailout. A move to use the legislative process to eliminate a superior, more consumer-friendly product, thereby bailing out the legacy banks from having to adapt or compete. It's an admission that they simply cannot beat crypto on a level playing field. The implications of a successful ban go far beyond Coinbase's quarterly earnings. This debate strikes at the heart of three fundamental issues in finance. Banning crypto rewards would deprive consumers of meaningful choice. For decades, Americans have had no alternative but to accept sub-1% interest rates from banks whose CEOs collect massive bonuses. Crypto offered a true alternative, a new, more efficient technology that could pass on higher yields to the user. A ban removes that competition, leaving the consumer with the same old, uncompetitive options. The ban essentially says, you are not allowed to earn more than we dictate. As Armstrong pointed out in a past discussion on crypto regulation, attempting to stifle or ban core components of the crypto ecosystem, whether it's rewards or staking, doesn't actually stop the technology. It just drives it offshore. If the US Senate passes a bill that makes it impossible for companies like Coinbase, Kraken, and other innovators to offer competitive products, those companies will simply move their operations to jurisdictions that welcome innovation. This hands a massive competitive advantage to foreign markets and makes the US a financial backwater. It is a regulatory self-sabotage that will cost America the future of finance. This entire conflict is a clear snapshot of the battle for financial modernization. Coinbase is actively trying to build what Armstrong calls a fintech super app, a platform that provides all types of financial services, potentially replacing legacy banks and becoming people's primary financial account. The banks see this goal, and they are using all their political power to stop it. They are not fighting against unregulated risk, they are fighting against competition.